Chris, can you explain what the lifestyle home loan is and how it differs from a traditional loan?
Sure. Thanks for asking, Dale. Well, you and I have talked a lot about this here recently, and I know it's been pretty new information for you. So this is a little known program that's actually been around since 2009. And this program is specifically designed for people 62 and over who are looking to purchase their retirement dream home from you.
Wow.
So this program is an alternative to paying 100% cash, and it's an alternative to taking out a conventional mortgage.
Wow. What is is there a target candidate for this kind of loan?
Sure. So again, if you're 62 and over, if they don't have enough cash to pay all cash for their retirement home, and if they definitely are not interested in making monthly mortgage payments, this would be a cash buyer alternative financing option because they don't have to use 100% cash. They have to put down somewhere between about 60 to 70% of the price of the home. And based on their ability to do that, they can finance the rest of that purchase with the FHA insured lifestyle home loan with no required monthly mortgage payments.
Wow, that's a cool benefit right there in itself. How is this like the flexibility on not having any mortgage payments?
Well, sure. Well, in retirement, most people are concerned. Their biggest concern in a lot of cases is running out of money and having enough money to be able to live the lifestyle that they envisioned in retirement. Well, if you have 100% of your cash locked up inside the walls of your house, that money's illiquid. You can't use it. Yeah, it's great you don't have a mortgage payment, but you've got a significant portion of your savings locked up inside the walls of your house. That's not very flexible. Also, if you choose to take out a conventional mortgage and you're going to be looking at 30 years of mortgage payments, when you add taxes, insurance, home maintenance on top of that, if you're on a fixed income in retirement, there may not be enough extra income left over to be able to live the lifestyle you envision. So it provides a lot of flexibility by keeping more cash in the bank and more cash flow because there's no required monthly mortgage payment.
Wow, this should open people's eyes to understand that. Something else, what about this non-recourse? What does that really mean?
Sure. Well, you heard me say that this loan is insured by FHA. Non-recourse means that the family or the estate can never, ever be liable for anything greater than the value of the property itself. So just like any insurance is always there in the background in case something bad might happen.
Right.
So it's very unlikely that that would happen, but FHA is in the background protecting the homeowner. It protects the heirs and the estate from ever being liable, and it also protects the lender.
Now, there's a lot more to this than I ever thought, that's for sure.
Well, and also, Dale, that gives people a lot of peace of mind to know that they can never be a burden to their children, or they can never be a burden to their heirs. So it gives people a lot of peace of mind, which is really important in retirement.
Oh, this is important information to get to people. How do you structure the down payment?
Sure.
How does that kind of work?
Yeah, so the down payment, as we discussed, Dale, it's a formula. In conventional financing, they work in fixed percentages, 80% loan to value, 90%. We don't have fixed percentages. Ours is a moving target. It's a formula based on basically three factors. It's based on clearly the price of the home that they're looking to purchase. We also use the age. We call this an age-based lending program because we use the birth date of the youngest homeowner. So it's a formula based on age and life expectancy. And then because it's a mortgage, there's an interest rate. Even though they're not making a payment, the interest is simply accruing. So the combination of their age, current interest rates, and the price of the home gives us a formula that determines that down payment. And it equals somewhere between 60 to approximately 70%, depending on their age.
Well, I can see having your company, Mutual of Omaha, behind you is a real asset for this program.
Well, think about it. Mutual of Omaha is a life insurance company. Who knows life expectancy is better than life insurance companies? So isn't it ironic that Mutual of Omaha would be in this business because it's based on the same principles as life insurance, and they've been around for 115 years.
Yeah, I've always heard that name for
Yes, sir.
many years.
A lot of credibility.
How about the income credit requirements, like on a regular loan versus this loan?
Great question. Well, with a regular mortgage, you have to make a monthly payment, plus your taxes and your insurance, and they have what are called debt to income ratios. Well, we don't have debt to income ratios because there's no monthly payment required. They can make payments if they want to, but the whole point is not to have to make any. So we do look at their income because as a responsible homeowner, you still have what we call our property charges. Property charges include homeowner's insurance, property taxes. If you live in a community that has a homeowners association monthly or annual fee, you have to pay that. And then of course you have home maintenance. So we have to make sure that they have enough monthly income to be able to cover all of their obligations. We do pull their credit, although we don't have a credit score requirement. We're looking to see if they have any other liens that show up on their credit report. Do they have a car payment? Do they have minimum payments on credit cards? So we want to make sure that as part of responsible lending, we want to make sure that they can cover all of their monthly obligations. But unlike a conventional mortgage, we're not hitting them for a principal and interest payment.
Wow, I could see that's some peace of mind for people getting older.
Sure, and it's also responsible lending.
How about consumer protections? What safeguards are there?
Great question, Dale. Well, when HUD and FHA created this program back in 2008, 2009, there's always been consumer safeguards with the HECM program. At the very beginning, there's what's called a telephone counseling session, where the homeowners get to make a telephone call to a independent HUD-approved counselor, and they get to double check and confirm everything they've been told before they move forward. So that's a consumer safeguard at the front end to make sure that they understand what they're doing and to make sure that they're working with a responsible lender that's explained everything to them. So it's a little buffer between them making the decision and making sure it's right for their situation.
Well, it sounds like y'all are looking after that community.
Well, absolutely. We're talking about a protected class of citizens, which are seniors. And so we want to make sure that they're not getting talked into something that may not be appropriate for them. So the counseling is a consumer safeguard on the front end. Plus, in our loan application, there's all kinds of disclosures. It's completely transparent. And then, of course, the big consumer safeguard is the FHA insurance, which is what protects everybody from having any personal liability.
Wow. What about, I know there's probably some misconceptions related to your program. Can you share what that would be?
Sure, great question. Yeah, I encounter that a lot. One of the most common misconceptions that some people have, not everybody, but some people think that the bank gets the home at the end, or they think that they might lose control of the home, or they think that the lender might take the title of the property. None of that is true. Banks do not want to own properties. Banks or lenders simply want their loan repaid. So just know the homeowner is always on the title of the property. They're still responsible for their taxes and insurance and upkeep, just like they would be on a conventional mortgage. So that's one misconception. The other misconception that people have, until they talk to me and they look at the numbers and we show them an amortization schedule, a lot of times they'll say, well, I want to make sure that I can still leave something to my children. And the way the formula is based on age, chances are, most likely, there's always going to be equity left over at the end. But what people don't think about is because they don't need 100% of their cash and because they're not making a monthly mortgage payment, they can actually leave more liquid cash to their children and combine that with equity from the sale of the home once the HECM or the lifestyle loan is satisfied. Wow. So when you look at it from a financial planning perspective, it makes a lot more sense that way. So I would say those are two of the biggest misconceptions that I find on a regular basis.
I think you even opened my eyes in that area. I wasn't clear on some of that myself.
That usually happens in most presentations I give. Most people say, Chris, that's not what I thought it was, or you've really explained it a lot better and eliminated some of those misconceptions. That makes me very happy.
That's good to know. What about some, client success stories, how they feel about that? Can you share a little?
Sure. Well, again, I've been doing this for about 15 years now. So I've closed hundreds of these loans. Pretty much they're all success stories. But ironically, I've actually had more than a dozen or 24 clients who have used the program. And then after 3, 5, or 7 years, maybe they didn't like that home. They actually sold that property, paid back the lifestyle home loan, took the remaining equity and used it again on their next property. So It worked out so well. But I'll give you a quick example. I just got a call from another real estate agent, and this couple, they're not able to sell their home for what they thought they could previously. So now they don't have enough cash to be able to buy their home because they're not walking away from their departure home with enough money. So this couple wants to buy a $325,000 home. They're going to sell their current home that does not have a mortgage on it, they're going to walk away with about $300,000. Well, without dipping into their retirement accounts, they can't afford that $325,000 home if they had to pay all cash. Well, we just ran the numbers for them, and they're around 79 or 80. And now with the lifestyle home loan, they only need to put down about $201,000 towards the $325,000 purchase price. So now they're going to be able to keep close to $100,000 back liquid in their bank account because they only need about $200,000 to buy that new 325 home, and they still have no monthly mortgage payment.
I bet they were excited when you told them that.
They're ecstatic about it. Now they're going to have extra money to enjoy their retirement. They're going to be in a home that's age appropriate for them and no monthly mortgage payment. They're ecstatic. And the real estate agent is ecstatic because he was able to have a new raving customer.
Yeah, that works all the way around.
Worked out well for everybody.
I'm just kind of looking at my notes here. I have, how does this loan enable homeowners to preserve their savings or investment? I guess you just kind of answered that question, right?
Well, sure. So if you think about it, now they have this extra $100,000. If they have a financial advisor, they could give that back to their financial advisor to invest and maybe preserve equity for their retirement. I've had people actually buy extra life insurance so that they can leave more of a legacy to their children. I even had one gentleman that had enough leftover cash. He was able to buy a condo for his daughter and his grandchild to be able to move in right down the street, and neither one of them now has a monthly mortgage payment.
Wow.
So the other thing that people can do is now they can put that money aside to help provide for possibly long-term care or in-home health care. So it opens up a whole realm of possibilities to now protect them in other areas where they might be exposed.
Wow, it's great that we're trying to get the word out a little more on this. These are some great things that I can see about the program here. What about, is there any type of properties that are eligible, or is there some limitations, or how does that work?
Sure. So it is an FHA program. So any FHA eligible property works. So single family residences, villas, townhouses, even 1 to 4 unit properties, as long as they reside in one of those units.
Oh, wow.
And there's only a few condos out there that are FHA approved. So if it's an FHA approved condo, then it would also qualify. But if it's not FHA approved, you might have some challenges in getting that approved.
So there's a big arena of units that would work, or
Yes,
houses.
sir. Yeah. It's very seldom that we run into properties that don't qualify.
How about, I know you touched on it before, how about air responsibility, or how does that work?
Sure. Well, a lot of people say, Chris, what are my kids' options? What if my kids don't want the property? What if they want to keep the home? So just know the loan does become due and payable when one of 3 things happens.
Okay.
We just touched on one. Just like if you had a conventional mortgage, if you sell, which you can sell at any time, you would just have to pay back whatever your lifestyle home loan balance is at that time, and the borrower walks away with all and any remaining equity, just like if they sold a home that had a regular mortgage.
Oh.
The second reason why the loan becomes due and payable is when both homeowners have passed on. So if one spouse predeceases the other, it's actually very comforting to know that the surviving spouse can stay in the home and also not make any payments.
Oh.
But when that second spouse passes, well, all homeowners are deceased, so the home still goes to the heirs or the estate, just like if it had a conventional mortgage. And just like if it had a conventional mortgage, the heirs have a decision to make. And that decision really comes down to, do they want the property or not? Typically they don't. So if they don't want the property, they simply sell the property, they pay back mom and dad's lifestyle home loan balance, and the heirs walk away with any and all remaining equity. If they want to keep the property, they would just have to have the means to pay back mom and dad's HECM balance. Sure. So if they inherit life insurance, or if they inherit other assets, they could simply pay off mom and dad's loan, and now they can keep the home free and clear. Or if they don't want to use all their cash, they could go to their own bank and refinance mom and dad's HECM into a regular mortgage and make payments.
Wow.
And then something else people don't know, that in the unlikely event that if the home is underwater, well, clearly because of the FHA insurance, the heirs are not liable for that deficiency. So they could simply do a deed in lieu, and they could walk away without having any liability. And then they also have another option. If the value of the mortgage would ever grow to be greater than the value of the property itself, which again is not very likely, the heirs or the estate can buy the home for 95% of the then appraised value.
Oh, that's something.
Yeah, I don't think you and I have actually talked about
No, I didn't
that,
even
but
know
since
that.
you brought that up, that's a whole nother option. So the heirs have plenty of options. It just really comes down to, do they want the home or not?
Oh.
No different than the same decision if mom and dad had a conventional mortgage.
Well, the one big take I take out of it is if they have this loan and they do pass away, the heirs aren't obligated for a time to make payments. So
Sure.
they're not jumping there and making payments right away.
That's right. So the rule is that they have 6 months to decide to pay the loan back. They can also get 2 90-day extensions if they communicate with the lender. So they get up to a year to decide. But unlike a conventional mortgage where they'd have to make mom and dad's payments until the home gets sold, there's no monthly payment. So the heirs aren't coming out of pocket during that period of time.
Well, what a great feature that is.
I think it is.
I guess I have a few other things here, questions for you. In closing, regarding what advice would you give to someone considering this lifestyle loan, but still kind of on the fence?
Sure. Well, we have a lifestyle home loan home buyer's guide. This is a magazine that explains the whole program. It talks about the history of the program. It actually takes people through the 3 options they have, which is paying 100% cash. What are the pros and cons of that decision? Taking out a 30-year mortgage or a conventional mortgage. What are the pros and cons of that? And then we also look at the lifestyle home loan and what are the pros and cons of that. So I invite people to read this, get properly educated, get all their questions answered, and then call me so I can fill in the blanks. I also invite people, if they have a financial advisor or a trusted advisor like an attorney or a CPA, to have them call me so we can make sure that everybody's on the same page, so we're all looking out for their best interest.
Well, I guess in closing, I guess you've kind of answered that. Your first step is to probably look at that nice brochure with all the information.
Read the lifestyle home loan brochure, give me a call, and allow us to walk them through and explain everything to them very transparently and clearly.
Well, thanks for answering all these questions. I think we get this out in the marketplace, people are going to want to call you to learn more.
You know, it's not for everybody, Dale, just like not everything is right for everybody,
Sure.
But I think it makes a very compelling argument that you can really have a much more secure retirement, have peace of mind that you're not going to run out of money, and still live in the home that you really, really want to live in.
Well, thanks. Appreciate your help.
Thank you, Dale. It's been